Hey traders, let's look at risk control in fast markets. Very apt at the moment. Stay tuned. Hey guys, warm welcome to you. Right, so as I'm filming this, we have a fast market condition. Actually, today's a little bit quieter. The Dow is only up 700 points, so we've been 1,000 points, but actually it's been quite a methodical type day, actually, interestingly. Before, a couple of days before, we've had whips up 1,000, down 800, up 600, down 5. Crazy moves. Anyway, got me thinking, risk control in fast markets. Some of them are obvious, some of them are not so obvious. Some of them are more mental aspects of it, because sometimes we're our own worst enemy, right? And some of them are more practical stuff. So let's have a look. First thing is, obviously guys, stops and sticking to them. So there's no use in you having stops if you leave a little bit more room and you pull it or you move it, or as I mentioned here, if you're going back into the trade as soon as you've been stopped out because you think that it was stopped out wrong. If you have that tendency, consider walking away, because then you can't go back into the trade. So if you find that you get emotional over a stop, or you're back into the trade straight after, or you're over trading, you're looking for the next trade straight away after you stopped out, consider just not being at the screen, putting the stop in, letting the system take you out of the position if you are wrong. The other thing is loss limits. So your daily loss limit if you're a day trader, your weekly loss limits, your monthly loss limits. Keep a good eye on those and a close eye on those, and don't go straight to them, ramping up to, hey, I'm going to risk $2,000 today, and you ramp straight up to it. You know, have levels where you have to reassess. So let's use that as an example. You've got a $2,000 daily loss limit. When you get to $1,000, you have to do something to say, hey, something's not quite going right here. If your weekly is 10K, you get to 5, hey, hang on, things aren't going right. So don't just jam straight up to your loss limit, because then it's too late to do anything about it. Have some kind of areas, if you like, where you go, right, hang on a second, I need to take stock, and the rule might be flatten everything and reassess and spend a couple of hours if you're swing trading, or an hour or half an hour if you're day trading, reassessing what's gone wrong. Is it just normal conditions, I'm just getting stopped out as to be expected, or am I trading incorrectly? So, you know, very important, that one. Another thing is tilt awareness. What do I mean by tilt? This is, you know, comes from the world of poker, people playing on tilt, and that's just emotional trading. So you just literally, you see the volatility, you want to buy it, you get stopped out, you want to sell it, you get stopped out, and now you're just going mad. You want your money back. You're just putting on size, you're trading this way, that way, just because it's moving. You have an idea, hey, the virus is going to do this. I'm talking about coronavirus, that's what's happening at the moment, but whatever's moving the market. When you're watching this, hey, I think it's going to do this, hey, I think it's doing that, hey, I've got a feeling it's that, hey, I read an article on that. You get the idea. The point is, you've got a structured way of trading. So listen, we're all susceptible to going into that mode, but the difference between a lot of traders is they go, oh, hang on a second, am I making the right decision here? Am I trading, am I going back into the emotional state when I need to really be a bit more cautious about what I'm doing? So being aware if you're trading on tilt, guys. Another thing is reduced size, pretty obvious. Just trading a lot less size in a fast market, just because you can get stopped out so much quicker, the move is so much more, you're going to have more risk on the table. Other thing is pair trading or hedging. Something that people don't think about is perhaps pair trading or hedging. So what does that mean? So let's say you are long basket of stocks at the low, few stocks at the low. One way you could hedge yourself off is by just selling a few NASDAQ futures, or selling a CFD, or selling a spread bet, or just going short the NASDAQ. So you're dampening down the moves a little bit. Now, of course, there are nuances to that, and you can get caught out with a differential, but at least if the market has massive headline risk and moves very, very quickly, you want to lose on one and gain on the other in most scenarios. So you've kind of taken a little bit of the risk off. Of course, it caps the upside, but what we're looking for is risk control in this. So that's something to think about, and actually something that in these fast conditions I've been doing a little bit more of, by baskets of stocks, looking at kind of some of the stocks that I thought were good trades, and thinking, hey, if I'm going to hold these for a day or so, I probably need to have a few NASDAQs selling short, just to cover a little bit of the risk on this. So it's worth thinking about, guys, you know, hedging yourself off, or pair trading across different sectors. If you're trading stocks, you know, pair trading across, you know, different sectors, and saying, hey, I think that's a good buy. Maybe I'll buy that and sell half of the position on another related stock, or whatever. So you're just dampening down the whole risk. Other thing is reduce the account balance to prevent overtrading. because you've now got effectively more leverage and more margin, because the market's moving so much more. Let's say it's moving 5 times as much as it normally is, you're getting 5 times as much leverage effectively because of the movement. So consider reducing your account size. If you normally trade 10 lots or whatever the number may be, doesn't matter what the number is, and you've got the balance to cover that and your potential losses and all the other stuff, consider just dialing it down, because then you can't overtrade, because the broker are not going to let you overtrade if you haven't got the margin in. So it's just like a real hard stop, if you like, from trading too much size. You've got a tendency to put on too much size, and you're putting on a big clip when you shouldn't be, then this is the market type of market you don't want to be doing it in. So just consider dialing down the account balance a little bit. No harm in it, as long as you've got enough to trade what you need to trade. The other thing is trade options. Now, not as simple as that, I know, because the premiums spike massively in fast market conditions, that's how options are priced, but they do, of course, cap your risk. So even if you're buying a call or a put, you will be paying a lot for it, because fast market conditions increase volatility, and that's one of the kind of parameters that adjust the price of an option. So you have got limited risk, but you're paying up for that. So it's something to consider. And if you like the limited risk, and guys, I've seen really super expensive calls or puts just go crazy still, because that's what happens. Markets can just keep going and going and going and going. So be aware of that. If you're thinking of selling options, and it is tempting because the premiums are so high, be very careful, because if you get on the wrong end of that can really end your career. But if you know what you're doing, of course, you probably have a strategy for that anyway. So trading options, fixing the risk by buying puts or buying calls or some kind of spreads. Trading CFDs, micros, or spread bets. So any other product that hasn't got a large, if you like, size. I mean, buy a futures contract in the DAX, for example. Big futures contract at the best of times for most people. When you're swinging around this kind of moves we've got, it's going to be out of bounds for 99% of retail traders, just purely because of the daily swings are going to be huge amounts of money, and most traders on one trade don't want to be risking that. It just doesn't make any sense. And so if you want to trade these instruments, consider trading a CFD where you can trade. Some brokers allow you to trade a portion of it, or a spread bet allow you to trade, pound a point, 20p a point in some places, and there's nothing problem with that. If you want to add a couple of those, scale into a position, dampen out the move, then it's much better to do that, protect your capital, than go in and trade. Start off with a one lot, which is the minimum. Obviously, you went to the exchange, and one lot, let's say on the Dow, of $5 per tick. If they're moving 1,000 points in a day, it's a 1,000 point swing. $5,000 swing. Now, for people, who've got a modest account size, you don't want to be swinging that much in a day on a one lot. So think of a 2 or 3 day move. So dialing down your exposure by looking at some of these other things that really allow you to reduce your position size, and scale in and scale out that perhaps other things don't allow you to do. So another thing as well, guys, is obviously you're trading shares. So if you want to trade the S&P rather than trading the futures, go and trade the SPY ETF, because of course you can go down to one share if you wanted to then, so you can really dial down the exposure that way. All right, guys, that's risk control in fast markets. What have I forgotten? Let me know. Comment section below. Take care. Whatever you do. Bye-bye.